Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Good morning, Ben.
Good morning, Will. How are you?
Licking my wounds after a rough sports weekend for the state of Missouri and, the surrounding area for the most part, but we're bouncing back.
Yeah. And for our listeners out there, Will and I get on and talk a little bit before this, and poor Will's just having a rough day. All his teams pretty much had a beating this week. That Mizzou game, I cheer for Mizzou, as many people know. That was one of the saddest, most heartbreaking ways to lose a game. But
yeah, lost it twice. It should go as two losses on the record, honestly, instead of just one. Yeah. We're just trying to save Brian Harson's job, but it's all right. So anyway, looking to the markets from the past week, hopefully they didn't do as abysmally as Mizzou and all of Missouri sports. So give me an update there. What have we really seen?
Yeah, so I think that one of the big news items of the week was back towards this Ukraine-Russian conflict that we've been talking about for months now. Kind of a renewed, heightened sense of urgency in the markets, and we see that play out in the difference in direction of these markets, right? So December corn down 12 cents, November soybeans down 50 cents to 14.11. Soybean oil up almost a penny per pound to 66 cents per pound. Soybean meal up down $5.60 per short ton. Old crop wheat for December up 28 cents. New crop wheat in July up 15 cents per pound to $8.65.
So really, excuse me, as you talked about some, renewed urgency there, looking at the Black Sea market and that region of the world. So really, what else, what other driving factors are we seeing that are really played a role this past week?
Yeah, so U.S. weekly ethanol production was down for the second straight week, falling 18 million gallons. It was a rough week for exports sales, U.S. agriculture export sales last week. Corn, soybeans, soybean meal, soybean oil, and wheat all came in below the most bearish pre-report estimates. I have never seen that happen before, to where every commodity was below all the trade estimates heading into the report. The Federal Reserve increased their short-term interest rates 0.75% for the third consecutive time this year, now sitting at a base of 3.25%. Open interest futures and options positions in Chicago wheat were flat on the week. Corn and soybeans were up 1% and 2% respectively. Managed money positions decreased 3,761 positions for Chicago wheat, 7,436 positions for soybeans, but increased to 7,266 positions for corn. The cattle on feed report as of September 1 was estimated to be 11.3 million head. That's up 45,000 head than a year ago and represents the second highest total ever for the month of September. U.S. weekly export inspections, very similar to export sales, were very disappointing. Corn and soybeans and wheat all were below the week before. Grain sorghum was just slightly up, ever so slightly there. Reported inspections for both corn and soybeans fell below the most bearish estimates there as well. 58% of the U.S. corn crop is ready to mature, and 12% harvested so far. That's just slightly behind the normal pace. Corn condition to good to excellent as a composite score was steady on the week at 52%. 8% of the U.S. soybean crop is harvested. That's behind the seasonal pace of 13%. Our normal pace of 13%. The national soybean conditions rating also held steady at 55%, good to excellent. 15% of the U.S. corn or cotton crop is harvested a little ahead of average pace. 27% of the U.S. grain sorghum crop has been harvested a little behind the normal pace for this time of the year. And then on the wheat side, 96% of that spring wheat crop has been harvested. And as we look forward to the winter wheat crop, 31% of the 2022-23 wheat crop has been planted.
So a lot of factors there, but I really want to kick off the conversation this week talking about some of the things you already brought up, mostly on export sales. Really a rough report coming into this week. You mentioned that's the first time you've seen something like that, where things were pretty much down across the board. So really, what are the factors? Well, what's really limiting, limiting U.S. exports right now?
Yeah, so you're correct. And I'm pulling up the US dollar index just to see kind of where we're trading at the moment. But really, two reports back to back here. Last Thursday's export sales report coming in below all expectations. And then the export inspections, which is the product getting on the boat and going across, wherever it's going, whether that's going to Mexico or Canada, or whether it's going to places like Japan and China. Two reports back to back here that just very, very bearish to the market, kind of continue to weigh, especially on corn and soybean markets as we look ahead. I think this is both I think there's two factors really playing in here, maybe three. Let's go three. So the first factor I think is playing in is this is the time of the year where we normally see export inspections, not low, certainly not as low as what we're seeing them now, but certainly low relative to after harvest when we have plentiful supplies. I think, if we had more product to ship, we'd probably be shipping more product. Of course, that would probably mean prices would be a little bit lower. But certainly, our supplies are available. Exportable supplies here in the United States are a lot lower, and that's tailoring in some of these exports and sales. The second thing is price. The price for these products is high, but then also the U.S. dollar relative to other currencies, like what we've talked about, continues to present headwinds for the U.S. market as we look for the next couple of months as these sales come in for shipment, in October and November. We're trading, the U.S. dollar is trading just above 113 relative to a bunch of other currencies. It wasn't that long ago that the US dollar was actually in the 90s, right? So below 100% relative to other currencies. And so that picture has drastically changed. And then the final thing I'll just kick out there is kind of this global slowdown in economic activity. And I certainly think that's starting to show up in some of these export numbers as well. So really kind of three things there that are kind of signaling some demand weakness as we look ahead.
So really looking at that, one of the things I think was pretty key that you pointed out was just the overall tightness that you're seeing in the market, mentioning that if we had supply to be exported, that we might be exporting more. So really, as we move through harvest, this isn't expected to be a record necessarily harvest. We're seeing some, quality, concerns or, production concerns with corn and soybeans there. So might we see that this trend continue just a little bit even after harvest starts to go through?
Yeah, so I think, yes. So available supplies would pick up, and that would certainly give us more to ship. But these other factors aren't going to go away in the next couple of weeks. We're still going to be struggling with economic slowdown globally, and I think we're going to still be, facing high prices and a strong U.S. dollar that makes our prices even higher relative to other products around the world. So certainly, I think we are seeing a little bit of demand reduction on the export side. And again, for our listeners out there, I want to make sure we understand when we do see tight supplies like this, regardless of the commodity, the first thing that always gets cut is the international market. In the United States, we believe that product is allowed to be traded to whoever has the highest dollar. And in a lot of cases, that's the closest market, or, like shipping the product, giving the product to the domestic processor or consumer is oftentimes, because of the transportation costs, the most profitable area to sell that product. So exports are always the first to go, or to be tailored back a little bit. And I certainly think we're seeing that at the moment, that this is kind of the start of some demand destruction, especially internationally.
So bringing up things like the general economy, you talked about kind of a general, slowdown there. We've seen increased interest rates here, through the Fed. What has that really done? What does that mean for farmers as those continue to rise, those rates?
Yeah. So again, I think the concern here is we see an increase in the Federal Reserve on their short-term interest rates, and this is set by the Federal Open Market Committee, right? And they increased it for the third time this month third time this year by 75 basis points. They've increased it, I think, now 5 times this year to varying degrees. And certainly, the market picked up on that, but it was exactly what I and the market. So like I anticipated a 75% basis or 75 basis point increase. So did the market. The Federal Reserve is doing exactly, I guess, what they have continued to tell us they were going to do, is that they were going to be almost predictive in their moves. And by, communicating through minutes and other things that these are the moves they plan to make. And they've done that. So the the general market sentiment last week really fell on not the 75 basis point increase current, it fell because the Federal Reserve came out and said, we plan for similar interest rate hikes like this through the remainder of the year. And now the market's banking in a 75-point basis increase again in October, here in just a couple of weeks. So, the increase, as fast as it is and for as long as it is what's really weighing on this market. You and I've talked about this before. The operating expenses certainly fit into farm income in terms of higher debt service. And then the other big thing, as we start thinking about a 10-year treasury having a yield or a bond yield somewhere around 6%, that's where it really starts to weigh on farmland values as we look ahead.
Well, it's kind of funny because it's, as you said, the market, it's starting to trust or believe the signals coming out of the Fed more and more. And it's kind of like, Pirates of the Caribbean. I can't remember which one of the movies it was, but it's like, they tricked us by telling us the truth,
That's right.
But looking elsewhere, moving forward, looking at the stocks report, some adjustments there. We're running out of time here just a little bit. So do you have a kind of a synopsis on that?
Yeah, so we'll get September 1 grain stocks, which this kind of represents the end of the marketing year when we think about demand for that final quarter, and we can start putting demand together for the year. So this is really kind of like that USDA will get to go back in January and revise the previous quarter, which they would have option to do this. But this is kind of the opportunity where USDA can go back and look at some of the demand over the last year and reassign to quarters and stuff. So, corn ending stocks the trade is estimating that they'll come in at 1.5 billion bushels for this quarter. That is up from last year when we showed us ending stocks in September 1 of 1.24 billion bushels. Soybeans are anticipated at 242 million bushels. That's reduced from the June 1st stocks number of 971 million bushels, but again, a very tight stocks number there as well. And then certainly on the wheat side, a wheat number that continues to remain tight as we had production shortfalls in the spring wheat crop in 2021. This year we had the production shortfalls in the winter wheat crop. So anticipating 1.776 billion bushels for that wheat crop, when last year we were basically right at this same number. So even though an improvement in the spring wheat crop, we basically flipped the script to the winter wheat crop, and we're expecting to see that play out in the stocks numbers as well.
So really moving forward, maybe some similar tightness, adding some support or holding support within the market until maybe we get to the end of the winter season into spring, whenever we see other countries start harvesting some of their grains there.
Yeah.
All right. Well, closing out for the week, is there any reports, or what key reports should growers be watching to potentially move the market?
Yeah, so ethanol report, the EIA gasoline and ethanol report will come out on Wednesday at 9:30 a.m. Central Time. Thursday, we'll have both the export sales at 7:30 a.m., but then also the third quarter hogs and pigs report comes out that afternoon at 2 p.m. Then on Friday, those grain stocks and annual small grain summary comes out at 11 a.m. And then the CFTC open or commitment of traders, which is that open interest and managed money accounts, comes out at 3 p.m.
All right. So things, especially like the hogs and pigs report, if you want to get some more information on that, check out our counterparts on the livestock side. That's the weekly livestock market update with Megan Grebner and Scott Brown with the University of Missouri. Ben, it's always a pleasure talking with you about the markets and everything surrounding them. So I appreciate you joining me this morning. I'm Will Robinson on Brownfield.